Hi, I'm Tanya Wolf.
And I am Michael Waits. Welcome to the Moneymakers podcast, brought to you by Sophia. Sophia is an exciting new learning platform for women with a goal to increase diversity and inclusion in early stage investing. This podcast is a finance, innovation, and investing show for women everywhere of all ages. Each fortnight, we will feature an inspiring woman from the investing and finance sector or a female founder with a special focus on Asia. Our guest today is Rachel Lau, a managing partner at RHL Ventures. Thank you so much for coming on and doing this today, Rachel. How are you doing?
Good. How are you? And thank you, Tanya and Michael, for having me.
I am super. Would you like to give our listeners a little bit of your background for some context?
Sure. I run RHL Ventures. We're a Southeast Asia only venture capital fund. We invest in Series A, Series B companies with the idea of obviously scaling their entrepreneurial journey or help with the entrepreneurial journey. And we've done this since 2017. My background was previously an equity analyst and fund manager in New York and Hong Kong. I came back in 2017 to do this full time with a couple of buddies of mine. And ever since, I've been back in Malaysia, an emerging market.
Welcome home.
Thank you.
You're welcome. The world has changed a ton, obviously, in the last 18 months, and I'm wondering how it's changed the investment landscape for RHL Ventures specifically.
I think it's been interesting, right? We now do due diligence online. I had a 4-hour diligence video for one of the factories maybe like a month ago. And so now I think a lot of things are online. You don't get the same touch and feel in terms of the human connection, but we've been pretty quick to adapt the digital adoption. And I think that's probably the biggest stark differences. We've also been a lot quicker in terms of deploying capital because of the capital that's being inflowed into Southeast Asia. If you look at the people setting up family offices or funds in Southeast Asia, I think this is probably the best times for Southeast Asia right now. And so I think, there's a twofold. We've got to be a bit more nimble and agile in terms of the way we invest, but also there's more capital chasing Southeast Asia. And I think, Southeast Asia is probably, there's plenty of tailwinds for the region to do well in the next couple of years.
Yeah, I could not agree with you more. If you look at just the number of startup deals to begin with, they're much larger. But if you look at the amount of capital that's been deployed, it's almost doubled already in 2021 for a full 2020. And 2020, frankly, even with COVID and all the other changes we saw, was not that different from 2019. The other thing that's also happened is that from 2013 until 2020, there were 19 recorded billion-dollar companies in Southeast Asia?
Mm-hmm.
This year alone has produced at least 8 to 10 more of them. And I'm curious, it's a really good point you make, right? Because there's so much capital pouring in. What does all this money coming in and these rising valuations mean for the ability for smaller funds to compete with the bigger funds for deal flow, particularly at the growth stage, like Series A and Series B?
Well, I think the reality is for you to be a good fund, you've got to also be able to fundraise.
Yeah.
The fundraising ability also speaks to your track record, right? And so I think if you're starting out right now, I think it's a difficult time unless you're playing the seed stage. You need a couple of years track before you do a Series A, Series B. So I think this is probably the time to tell. The guys who have done badly over the last couple of years aren't able to do the next fund. The people who have done well are doing the fund 3, fund 4. So I think, there's a big divergence of performance, not just so much on a fundraising perspective, but also like the track record perspective, right? In 2020, when everybody was fearful, I was bored. And so, we ended up deploying quite a bit of capital, more because we were bored more than anything else. This is the first time I haven't traveled, right? So then you realize, because you haven't traveled for, a year and a half, I haven't traveled since January. It's 20 months already.
Yeah, me too.
You end up not doing very much traveling, and whatever time that you spend on travels, now you're spending on deploying, research, focusing on trends, focusing on what's going to be happening next. And then, I guess the idea is obviously to deploy a lot quicker than, what we typically have been. And so I think the speed of the velocity of investing last year has been triple the speed of what we've typically done. And I think this year you've seen it pay off, right? Because, I think the way we saw it was also in the first lockdown in March 2020, I had a lot of annoyance in terms of getting fresh foods. And therefore, we invested in quite a bit of food procuring companies. When you do a lot more work into the food space, you realize that there is a huge food security issue around the world. And Southeast Asia being, a food supplier was primed to do well. And so we ended up investing quite a bit in food, which then again, I think people caught up with the team 18 months later. And so a lot of our startups are doing, the 2 or 3 rounds after we've invested in them last year. So it's been okay.
So is it just the food sector that's different for you, or are there other things that you've noticed? I mean, I agree with you. This is the longest time in my life, and I'm double your age, right, that I have not been on a plane or left the country or the city in which I live. It's really strange, but it has
Mhm.
given, I think, everybody a focus. I've worked harder. I've been way more productive. And I've also noticed things that I hadn't noticed before. Are there any other sectors that you've noticed while you've been doing all this extra work and all this extra due diligence besides the food tech space? And in particular, I'm thinking about ESG in general.
Yes. So we've done quite a bit in food, and because of food security, we've done a lot in the agriculture space as well.
Yeah.
And I think, for us, it's more if you do good, you would do well.
Yeah.
So when we look at sustainability, we're investing in guys who are helping the young farmers, people who have agriculture degrees, double their salaries, and then, going into farming, which they love to do, right? I think typically what has happened in the past was people don't go into farming because it was not as lucrative as being a salesperson in the city. Now we're trying to change, the perception of it, or we're changing, the payoff of it, right? If you've got a good agriculture degree and you understand how to do farming very well, not the way, our parents did farming or the great grandparents did farming, right? Where you have a bull and then, you get an ox to kind of, do the farming. Now a lot of things, we have IoTs, everything is sensor based, how much water, how much fertilizers, how much sun. And then, essentially when we get that, for example, like FIFO, which we've just invested, it focuses on short crops. And what happened is, once we get that, we also take the crops and we amalgamate it. And then we sell it to other portfolio companies of us, which is G Life. Essentially, you get better pricing because now we've got good quality crops. We've amalgamated good quality and good size produce, and we send it to Singapore. And these are to the HoReCa. This is to your Hyatt and not typically just to your supermarket in Malaysia.
Right.
So the ability to do this a little bit better. And again, it's the digitalization of things because now, like G Live knows how much we produce and how much they need. And then, I think it's a one stream process. The supply chain is a lot more effective at this point. When we look at, sustainability, it's really just helping the guys that's most marginalized over the last couple of years. But also, at the same time, I was speaking to a friend and we were talking about the fact that with COVID, we've seen a huge disruption, even in terms of innovation, regulation, everything, all the rules are thrown out the book. And so, essentially, we're giving back consumers the choice to choose. If the produce is cheaper, better quality, then, consumers will be smarter. And therefore, it helps, the bottom line of your average consumers. So delivering nutrients to everybody and giving accessibility to that, is very important for us. And so then another team, we've ended up doing quite a bit is healthcare. COVID showed us, the stark differences of the haves and have-nots. Right. I was extremely peeved by the fact that, people who were able to afford it got hospital treatments, where all the people who couldn't afford it, either they've got to do their daily jobs and couldn't do that, or they couldn't afford, hospital treatments. I think right now we're focusing quite a bit on delivering healthcare cheaply or insurance cheaply to your average consumers. And then hopefully, we solve the part of the basic human needs of food, security, housing, healthcare. And we can do that. I think, that's a powerful way of moving the world forward in terms of like achieving equality in some ways.
Yeah, I think it's really important. You mentioned two things, obviously very important to me. In the old days, people used to say like insurance wasn't sexy, right? But now the whole idea of what an insurance person is has completely changed because of insurtech. And you're seeing the same thing in farming, right? In the old days, again, a farmer was perceived as somebody who was poor, not connected to the rest of the world, and just like an old woman who was planting rice. And now it's changed to the daughters and granddaughters of those people carrying smartphones with IoT connected devices and drones flying over their property, optimizing farming. And what Chris Fong and the team at FIFO are doing actually has been pretty amazing, trying to bring farming into like the 22nd century. I know that's an exaggeration, but really move it forward and make it cool for people to do, along with dealing with these things that you were talking about as well, with accessibility and inclusion, which are really important and are key to the environmental sustainability and governance, the ESG space for investing. And I see that happening across the VC space too. Do you think that's unique to what RHL is looking at, or do you see that also becoming part of the main VC investment thesis?
I don't think this is exclusive to us, but I don't think a lot of people have done it. People talk about it, but then I don't think they've actively looked into it. I don't think we've actively looked into it. I think we've kind of fell into it, if you know what I mean.
Yeah.
More because I think when you started investing, you realize these are good guys that you want to back and you're doing the right things,
Yeah.
right? And if they're doing the right things, they'll probably do well. Whereas the guys who were too conscious about their profits, for example, or were chasing e-commerce, for example,
Yeah.
I think those ideas didn't really speak to us.
Yeah.
So, we ended up investing in the guys who wanted to make a difference because we wanted to make a difference. Again, everything was very organic. We didn't really say, hey, this looks nice on a PowerPoint slide, and then let's do this. It was really, we felt really strongly about their vision and, the mission that they were undertaking. And so we were happy to back these guys because, it just resonated with us.
I just have a couple of questions around the food tech sector. I'm wondering what your thoughts are on the readiness of the Southeast Asian market for considering a healthier lifestyle, and what your thoughts are there.
I think with COVID, things have changed significantly in the sense that people do care about it. We've invested in healthy food, we've invested in procurement, as we've talked about, co-farming, alternative food. People care about it more than anything else. Again, the way to do it is to eat healthier, to be healthier. A lot of my friends who were really chubby prior to COVID have now slimmed down tremendously, right? One, because there's no entertainment at night. So you kind of end up doing a lot more exercise. Also, it's an excuse to get out. And so once you're exercising every day, you automatically slim down. And once you exercise, you're not going to indulge in as much junk as you would be in front of the TV and munching on popcorn. So the idea is right now, I think if we can keep up with the exercising and the healthier lifestyle, then, I think we will have a healthier demographic. So I think Southeast Asia has picked up in terms of the habits, all the good habits. And I think this is probably the good thing that's turned out from COVID.
Yeah, I agree with you. I'm a cyclist here in Singapore, and I've seen a significant number of people that were clearly not cyclists pre-COVID out on the roads and the cycle path. So I agree with you. There are some positive changes. Switching gears a little bit and looking at another one of your portfolio companies that caught my eye, and I already obviously knew of them, but I was very intrigued by your investment into Coffee Meets Bagel, not least because 3 sisters, co-founding team. So that definitely caught my eye at the time. But I wondered if you could talk to us about your motivations around investing into that business.
Well, the girls came to Asia a couple of years ago. And the idea was obviously they found the way people to be dating really difficult. And at that point, it was also Tinder. And they wanted to debunk the idea where it was a hookup, right? Our relationship should be hookups and superficial. So they ended up creating an app that, wanted to focus on deeper connections. And so that was the thesis behind it, We really like the idea of deeper connections, better interpersonal communications. And so really that's the reason why we invested in them. The girls were really smart and are really smart. And I think they've done really well. So COVID has changed the ways that people have interacted. Now there's a lot more authenticity into the conversations. Well, this is what I was told at the very least. I haven't tried it. And so there's a lot more authenticity in the conversations. They do video calls. They don't flake. I don't really know whether that's the right word, but they don't flake when, they're having a coffee meetup now because, I guess people treasure relationships a lot more at this point. And so it's been a good time for them. For us, they're also looking to come to Asia or Southeast Asia at the very least. So it was, a synergistic thing that, a strategic thing that we've done just to help the girls out.
Yeah. So they created the business to fill a need that they saw, the gap and a problem that they were having with the other dating sites, which I think is quite common for women when they're building businesses. So that's really interesting. And then would you consider that RHL has had a pivot? Because you didn't start as a venture capital fund, am I right?
We started as a family office that focused on venture. So the first few funds were actually family backed, and then we've taken outside money. It was actually a cautious decision to do that. The way we saw it was we were always going to do third party capital. So I don't think it's so much a pivot, but when we first started, it was actually family funded.
So I guess that when you first to raise capital, you talked earlier about track record. You already had that from your own capital or the founder's own capital. So raising external capital for the first time was easier. Would that be the right word?
I wouldn't say easier, but I think we've got the privilege of putting our own money down, right? And I think that speaks a lot to the fact that we were the leader in the investment process, the investment teams that we were investing in. And then after a couple of years of doing that, you're able to say, we've done pretty well. Here are the success stories. What do you think about them? It happened organically where people wanted to come in because, to be fair, if you're doing good work, people do approach you. If you're not investing in tech, you're left out. I'm doing any digital adoption. The odds are you're not going to be able to survive COVID.
Yeah.
So I think this year will probably better than last year, but I think these 2 years are the best years that we've ever done in terms of performance, in terms of money made, in terms of like startups. It's a really good 2 years because I think the more people aren't able to go out, the more they turn to their phones, either, their mobile phones or their laptops. And so, we're heavily invested in digital. And I think that speaks to itself.
Yeah. Thank you.
So can we go back to this thing with the amount of money that's coming in and the valuations are higher? I just want to follow up on that a little bit as well. Normally what happens, I think cyclically, is that as you get all these billion-dollar companies, the founders build up their own nest eggs, and then they start investing as well. So are you seeing that happen?
Yes. So we've seen guys from Grab quite a bit. I wouldn't say so much them investing per se, but there's quite a few guys that came out to start their own company. So I think there's a twofold phenomenon that comes out of this, right? One, the founders are investing in smaller companies. Joseph Paul from F17, for example, has started Tune Capital. I should charge him for this plug.
You
and
should.
so, he's investing because we're investing in a company of his because he decided that he wanted to be the angel investor. It's a Series A company. He's invested a check into it. There was 2 investors in it. I said I wanted to come in. They said, don't worry about it. So we're coming in at Series B level. So we've helped him quite a bit. But Joseph and I have done really well. We've helped him on M17 multiple times. So anyway, someone like Joseph is investing into startups. But the other phenomenon that we also see is the guys that have worked in Grab or Traveloka or Mocha to begin with, coming out to start their own companies. And so we've got an alumni of, the unicorns. And these are the younger guys starting the next generation of startups. It was similarly to what happened in China where the Alibaba, BAT guys came out to start their own companies. Now we see these guys, right? They've trained in unicorns and now they've come out to do their own thing. And again, that's where you foster innovation and they've got their training.
Yeah, I mean, this is just like the PayPal mafia in the United States, right?
Correct.
I guess my follow-on to that is the more money comes in and the more these more experienced founders start companies, does the bit switch a little bit? In other words, in the first generation of venture capital or seed stage investing or startup investing in Southeast Asia and really anywhere, it seems like people with the money have the most leverage. I know it's a maybe, but does it switch now to where the founders have more leverage? Are you seeing that at all? Where they get to choose their investors now?
Yes. So I think that has obviously happened in the past too, but a little bit more now. Founders are choosing guys with a similar vision with them. And to be fair, because there's abundance of capital, they've got the ability to do that. So I'd say yes. I think founders are a lot pickier. And to be fair, I think who has done well or not been helpful as an investor, it kind of tells very quickly now. So yes, I think as a whole, founders are in a better position than they've ever been.
I think so too. I look at the Andreessen Horowitz model in the United States, where they've literally hired tons of people to build individual departments, literally like accounting and human resources and other departments to help founders. Do you see that happening for the vertically integrated venture capitalists out here? Does that give somebody an edge?
I don't think we're there yet. I'd say we're near 2 or 3 in terms of the startup ecosystem, in terms of, this is where the US has, 20 to 30 years ahead of us. So the ability to do that, I think one, you need enough of companies to be able to do that. And number 2, you've got to have enough of AUM to do this, right? So at this point, I don't see it happening in the next 2 years. But I wouldn't say in the next 10 years, this is not going to happen. And I think it's probably needed, right? Because how do you differentiate yourself? Besides, I was reading an article and the venture capitalist asked, what's your SKU, da, da, da. And the founder asked, what's your differentiation? And the answer was my brand name. So it's quite
Yikes.
interesting. And apparently that was from a Tiger guy. And so the
Wow.
way that I think people have differentiated itself changes a little bit. But I think as we become more competitive and the landscape has shown to be,
Right.
I think we'll have to find a way to differentiate ourselves a little bit better besides our brand name.
I think you're completely right. Yeah, and I'm not surprised by the person that you said that would say that. But anyway, that's fine. I'm curious what you think the role of media and content creation play on both sides of the startup table, right? I mean, I noticed you have a very, very well developed and actually beautifully designed insights page, right? It's really, really beautiful to look at. But I was also amazed, and I'm sure you know this, I was amazed to find out from LifePal's Benny Fudgerai that they had 4 million monthly visitors to their blog
Wow.
and 500,000 followers on Instagram.
Wow.
Yeah, it's amazing, right? And I was just curious how you look at that, both from an investor standpoint and from a company standpoint, the use of media to not just build the brand, but to become more successful.
I think we're a lot savvier than our parents were. And so we understand media and social media and branding and marketing. I was talking to another friend the other day, and we haven't done ourselves justice in terms of branding. Asian companies haven't done themselves much branding in the past, right? But this generation of entrepreneurs are a lot smarter in terms of the ways they've looked at media and branding and marketing and everything else. So when we roll out insights, it's really topical things, either current affairs or what's in my head, right? A lot of times it's what's in my head, and I'm curious to find out what it's about. And if I've already done all the work in finding out what it is, for us to write one pager on it, it's pretty quick because you've already done heaps of work on it. And so for us, I think how we differentiate ourselves in terms of EC is that we've got more insights than everyone else. Someone said power is knowledge. I think we pride ourselves in the data we collect. And so you've got 4 or 5 years of data in terms of what's happened over the last couple of years. We've got a database of 3,000 startups with all the metrics. And so honestly, it's hard to do badly if you know everything. And so the way you invest, for example, and if we're not very smart people, we just have to invest the guys who are relatively better than the rest of the other guys. And so that's how I tell people, right? If I get hit by a bus, don't worry about it because everybody knows how to do the process. All you need to do is do a lot of work on it, So we spend a lot of time forecasting trends. We spend a lot of time on the research department, and we spend a lot of time looking at how things has panned out in the last couple of years since we started our VC journey, right? And so if you're doing that and you've got all the data, it really isn't that difficult to do well. And again, people talk about, data collection, but on the startup space, but they don't do it themselves, which again is quite amazing for me.
I was going to say.
It's the old hedge fund model, right? You just get as much information as possible, and then you just outperform everybody because you've got either information arbitrage or time. It really is it. So if we've got both time and information on our side, we should be okay.
Yeah, I mean, it's a question I spend a lot of time asking investors, and that is, if you expect the companies in which you invest to be using data to outperform their peers, what are you doing along the same lines, right? In other words, if you're just investing and you're suggesting you're not, but if other investors are just investing based on their gut instinct, well, then they're missing the whole point, I think, at some level, yeah.
We would track all the companies, we score them, and there's obviously, over time, we've tweaked a little bit in terms of the criteria and how we see companies. But by and large, the criteria of, investing has been similar, right? Product market fit, management, sustainability, margins, gross margins, net margins,
conversions, all this stuff.
And I think so these are basic stuff. And then we rank everything. And so then there's a bell curve, right? And so if you're at 80% or like the top 2 percentile, we automatically put a lot of focus on the company and we do a lot of work on it. Because the reality of it is, if this company looks much better than the rest in terms of all the criteria is, then we've got to find a reason not to invest as opposed to a reason to invest. And I think it's much easier in terms of making sure that we choose the right companies and making sure that we're not in a bad mood that morning where we've met the founders or we're biased judgment because it read something bad on the newspapers. And so having to do that and that discipline kind of takes away the luck in the whole equation as well. So I'm a big believer that if you do enough of work and you're hardworking and if you spend enough time researching these companies and speaking to everybody, you should be ahead of the curve.
And is your database regional only? In other words, are you just looking at companies in this region, or are you trying to take a look at global data, maybe segmenting by US, Europe, China, and then trying to see the trends that have already happened there as well, and seeing if you can find somebody here that's trying to do that, and if not, maybe even venture build with them to create that thing?
So the database for us has only been Southeast Asia because these are companies that we've spoken to.
Yep.
And so, I mean, ideally, I would like to try to be global, but we don't have that amount of resources. I think the global scene, especially the US and China, there's a lot more literature to it.
Yeah.
Whereas this part of the world, if you look at PitchBook or Traction, the information is just not enough. And so we've only focused on Southeast Asia. But that doesn't mean to say that we're not going to do the rest of the world, eventually. I think when we've got more capital and more resources, we probably will go down the path.
Got it. Tanya?
Can I just delve a little bit more into your thesis?
Sure.
So obviously your early stage, mostly A and B stage, would that be correct to say?
Yes.
Yes.
Right.
Yeah. And you're largely sector agnostic, but clearly we've spoken about a couple of sectors that you're particularly interested in, specifically since COVID, and obviously largely Southeast Asia with a couple of opportunistic investments outside of the region. Now, I read an article some time ago where you were talking about the difference between RHL and traditional venture capital funds, and in particular, the unicorn chasing or not, and targeting more sustainable growth. Can you talk to us a bit about that and what the differences are that you see between yourselves and most venture funds?
I think the points that I brought out in terms of research and data is probably the biggest and the starkest difference. The other difference is we don't really worry too much about the moonshots. And so when I invest in a company, we don't worry about these guys being a unicorn or not a unicorn. We invest in the fact that they're a good business. And again, I think there's no shame in getting a 5x on investment, right? And so the way we look at it is like, what happens in the next 1 year, what happens the next 3 years, and what happens the next 5 years. The reality of everything, and I think if you build businesses, and a lot of our families have built businesses before, is that it takes 20, 30 years, right? And it's multiple cycles before you find a unicorn. And obviously now it's a lot shorter. Maybe now it's 10 years, but it did take 10 years for Traveloka and Grab and a lot of these guys to become unicorns. And so we don't really want to focus on the 10 years because, 10 years is great, but let's worry about what happens the next 1 year, what happens the next 2 years, and then what happens the next 5 years. And again, find a way to help these guys achieve all their milestones, all, things that they've set out to achieve. And I think that's it, right? And again, I think if you're able to weather the 1, 2, 3, 5, 10 years, I think you'll get a good company. So we're not so worried about doing moonshot bets. And again, when I say no moonshot bets, we're unlikely to do the sending someone to space kind of bets, right? It's not what I do. I don't really understand it. Another thing that we don't do is biotech. When you ask me or you tell me that this is going to cure cancer, I mean, I like the idea, but there's almost no way for me to do diligence. And so these are 1 in 1,000 or 10,000 bets, which we're not comfortable taking. What we're good at and what our strength has been to scale businesses. So either, helping them with policy making, helping them to grow into other verticals or going into a different market altogether. That's probably where we're strongest at. And I think that's probably where we will continue playing in.
Yeah. Do you think that gives you an arbitrage opportunity when it comes to deal flow with that type of strategy?
I'd say not so much in terms of arbitrage, in terms of that strategy, right? Our other strategy is when we like a company, we actually chase after that company in a sense that we're not so worried about waiting for a primary round. We go in a secondary. And so we'll go in. And again, I think this is the beauty of having lots and lots of data because now I know who the shareholders are on the cap table. Right. And so if I really wanted to get into the company, I'm not going to wait for the primary round, which might happen this year or next year. And then I can't figure out my IR. So what we end up doing is going into the cap table and saying, hey, these are the seed investors. It's been 6 years. I think they want to exit. Why not approach them for an exit? And then obviously for us, it's building a portfolio that we like and not waiting for the right time for an execution. So we don't really wait around and do absolutely nothing when times are bad. And I think that was what happened to a lot of guys last year, right? Because they were worried that their valuations might not be up to par. And so we'd say, don't worry. There were some guys who wanted an exit. We're friends with a lot of guys, but we ended up bailing a lot of guys out in terms of the investments or companies that they needed to exit.
Yeah, makes sense.
So we'd like to thank Rachel Lau, a managing partner at RHL Ventures, for coming on and doing this today. We really appreciate your time. That was super.
Thank you, Michael. Thank you, Tanya.
Thank you, Rachel.
It was great chatting.